Hello everybody and welcome to this new video entitled A Diversified EBITDA Positive Hypergrowth Rule of 40 Plus Portfolio. So this is kind of my next take as to where I want to take my weekly spreadsheet. And there's a few stocks that I've added on there to make the spreadsheet more diversified. But in a nutshell, the idea behind this spreadsheet is to find a compelling stock in each of 9 entirely different categories. So diversified, right? So hopefully the returns will be great for many of these companies, but uncorrelated, right? That's the key. You want to find a company that may have great return, but it's not going to have a high correlation. That way, if an entire sector is down, your whole portfolio is not down. And I also want to highlight that I've added the rule of 40. And the rule of 40, what is it? The goal of the rule of 40 is to add EBITDA margin, which in the typical rule of 40 you would use profit margin, but I consider profits to be an inferior metric to EBITDA. I think EBITDA is a better way to incorporate the economic benefit of a firm, the economic profitability of a firm. So I have EBITDA margin and a revenue growth, and you add both EBITDA margin and revenue growth together to get to this number right there. And the goal to have a rule of 40 is you want that number to be above 40%. This is a time-honored SaaS metric that's often used in SaaS for investors in SaaS to make sure that they're investing in the right company and that they're investing in a company which over the long run will have satisfactory returns. And you can see that a few companies I'm getting at rule of 40, namely Enphase and Crowdstrike, but all these other companies are well above the rule of 40, or my spin in the rule of 40. Actually, this portfolio, the average is a rule of 60 on average if you did an equal weighted portfolio. What else is new in this type of spreadsheet? Well, I've added enterprise value over revenue. The reason why I've added EV over revenue is because, let's face it, it's a widely quoted metric, enterprise value over revenue. Everybody quotes it. It's easy to understand. You're just looking at the sales, and if the sales go up, you keep the same price to sales, but the sales go up next year, then in theory, the value of your stock should go up by as much as the sell has gone up. In theory, now in practice, we have multiple expansion and multiple compression on the price to sales multiple. If I were to be asked, I much prefer price to sales over price to earnings, because earnings can be all over the place. They can be manipulated. Companies can decide whether they want to have earnings or not, and the market has definitely been pushing so many companies to have earnings when, in my view, they don't need to. I prefer enterprise value over gross profit. Gross profit is a better metric, because typically what you'll find is that gross margins do not change as much. They do not change as much as, say, earnings. Earnings can change a lot more than gross margin. Gross margin are a good indication of the type of business that you're into and the profitability in the business. And if you look at, of course, companies that are more hardware-oriented, right, companies that sell physical goods, Tesla and Enphase here, they're going to have lower gross margins because they sell physical goods. Companies that sell mostly digital goods are going to have much higher margins. So, and lastly, of course, if you're new to the channel, you know that my favorite metric is enterprise value over gross profit over revenue growth. What is this metric? In this metric, I ask, how much am I paying for each percentage point of forward growth? How much am I paying for that forward growth? What's the cost for each percentage point of that? That's my spin on the PEG ratio and my improvement of the PEG ratio. So let me now go through each of these stocks. So as you know, Tesla is my number one position. I happen to believe actually that this spreadsheet does not capture adequately the value of Tesla, because Tesla is a stock that tends to move up by going through step changes in the valuation, right? It will be flat for 4 or 5 years, and then the stock will do a 10x. And the key is to be in the stock, because you can't know if that 10x is going to happen at year 3, year 4, or year 5, right? Tesla can unlock a lot of binary events, like let's say full self-driving, for example. If full self-driving becomes a thing, there will be a valuation reset that's probably going to be very, very, very quick. We saw that happen with NVIDIA. NVIDIA ran up so quickly. So these stocks can run so quickly, and sometimes it's a binary event. So Tesla, nonetheless, expensive growth, expensive stock compared to all of the other stocks in this spreadsheet, keeping in mind that I've chosen all these stocks because they're cheap. There's many stocks that I cover on the channel that are more expensive than Tesla. They're just not in this spreadsheet, of course. But what's interesting for Tesla is the rule of 40. We are above the rule of 40 for Tesla because we have a 16% EBITDA margin on Tesla, and my prediction of revenue growth for them is going to be 36% next year. So we're at 52%. We're well above the rule of 40. Now, moving on to Enphase. Enphase is actually saved by how profitable this company, because if you know anything about Enphase, you know that they are shipping less microinverters right now because they overstocked their distributors last quarter and the quarter prior. So they're actually going to have a down quarter in Q4, which means that predicted revenue growth over the next 12 months is actually only 13%. But look at what saves Enphase. What saves Enphase is that EBITDA margin at 27%. Believe that. Can you believe that? 27% EBITDA margin. That's extremely profitable. So thanks to the EBITDA margin, they are right at the rule of 40 because I add the 13% in sales growth and the 27% in EBITDA margin, right? The money that they're making, the cash flow that they're generating, and I'm getting a 40% for Enphase. So good for Enphase here as far as valuation goes. Crowdstrike is another stock that I like very much. But that, depending on the metric you look at, a lot of people find extremely outrageous, extremely overvalued at a 20 times sales price to sales being a 20. A lot of people say this is quite insane, this valuation for CrowdStrike. I think this is a winner-take-most market, the market of cybersecurity, and CrowdStrike is far ahead of its second rival, which is SentinelOne, which is why I believe even though SentinelOne did well in their last earnings, I don't believe they're going to catch up to CrowdStrike. CrowdStrike is too far ahead. This is a quality business that has given us long-term guidance. We have guidance for CrowdStrike until 2029, and it reaches the rule of 40, despite the fact that EBITDA margin is only 1%, right? Much of that rule of 40 is achieved for CrowdStrike at a 39% revenue growth. Noting that I have stocks that I cover on the channel, by the way, which are on the rule of 40 alone because of the revenue growth. And so they may be having negative EBITDA margin, and so you subtract that to very high growth rates. So even if you subscribe back from very high growth rates, you're still getting past the rule of 40. And of course, that's the cybersecurity space here for CrowdStrike. So you see, we have electric vehicles, and we have solar, and we have cybersecurity, entirely different fields. Then I want to talk about HIMS. HIMS is a stock that have been pounding the table for a long time for HIMS. HIMS is a cheap stock. It is still very cheap at a 0.044. How much am I paying for that growth? I'm paying the cheapest price out of all of the stocks that are predicted to grow, 40, 50, 30% in this spreadsheet. Out of all of these stocks, HIMS is charging me the least for that forward growth, if that makes sense. HIMS is trading at the least amount of money for the forward growth that you get. This is a company that's predicted to grow at 59%. It's got gross margin of 81%. The gross margin of HIMS is consistently super high, above 80%, even though they've guided a year and a half ago, 75% gross margin long run. We're still above that gross margin. And if you look at HIMS, they have just achieved in Q3 5% EBITDA margin, and that the long run EBITDA margin for HIMS that they've guided is between 20 and 30%. We have guidance for them up until 2025. They've given us long-term guidance, guiding 1.2 billion and in 1.2 billion in revenue is what they've guided by 2025. I happen to believe they'll reach that number much sooner because HIMS is mostly a subscription business. It's a recurring revenue business. Briefly, if you're new to the channel, HIMS, what does HIMS do? HIMS is an e-doctor, a digital doctor. Actually, last quarter, they did 14,000 visits a day. Believe that? Can you believe that? It's insane. 14,000 visits a day is what HIMS did. I was reading the conference call earlier today. 14,000 a day. And it's an e-pharmacy because once you see a provider from the HIMS platform, once you go see them, if the provider deems you eligible for a drug, most ailments, whatever they are, most ailments are fixed with drugs nowadays. So HIMS will provide the drug for you. So it's a digital pharmacy and a digital doctor, and it's all of this without insurance because HIMS functions entirely outside of the insurance space, and because of that, it is able to achieve very high growth, very high efficiency, and charge less than copays, or at least that is the way that they are marketed, and that is the way that they are adopted, because people find out, well, wait a minute, I like transparent pricing, and that pricing is cheaper than my copay, so I'm gonna go with HIMS and not use my employer's insurance or anything like that. So I like HIMS very much, and we are at above a rule of 60 for HIMS. New stock for the channel is Oddity. So I yet have to do a full analysis on Oddity, but I'm putting it in there because even though you may have seen my video from a few days ago, the beauty space is a space that I haven't explored too much. But a few days ago, I did do a deep dive on a few of these stocks, and I find Oddity to be a very interesting company. This is a company that has two brands. One of them is called ENPH, another one is called Spoiled Child, and the CEO is very confident about these brands both becoming $1 billion a year in revenue within the next few years, $1 billion a year in revenue, and they are working on two new brands. Oddity is a very interesting business. It uses AI and a matching algorithm to sell customized cosmetics or customized products. So their product ENPH, for example, is one where you will scan your face and then it will recommend a product based on your scanning of the face. So it's hyper personalized. Oddity has a very high repeat business where once a woman has gotten her foundation with Oddity, with ENPH, they want to go back with them because they've already done the scanning and they've already done the process. And this is a bet on the end of selling cosmetics in a face-to-face environment and the start of selling cosmetics online. I think it's a very compelling business. Amazing gross margin at 70%. Yeah, we forget about that. That's a physical product. But you know, these cosmetics have margins almost similar to pharmaceuticals, which is amazing. And the CEO has guided growth at 50% again. 50% revenue growth is what they've guided. And they are already achieving 20% EBITDA margin. So if you add 20% EBITDA margin to 50% revenue growth, you add both of them, you get a rule of 70 on Oddity, which I find a very interesting company. Then and it's in the beauty space. So again, diversified, not correlated. What do we have? Payment space. So another stock I've been pounding the table on is StoneCo. So StoneCo is the leading small business payments terminal in Brazil. They are like Square in the US, not Square the company, but Square the payment terminals for small business. You know, it's pretty much one in the US. It's like all over. Well, in Brazil, the leader is called StoneCo, and they are doing very well, and they're still growing very fast. Keep in mind, they have about 3 million small businesses using StoneCo right now. Keep in mind, Brazil is a country that has many more small businesses than the US, and it even has a category of business which they call micro businesses or nano businesses, which we don't have in the US. In Brazil, they're largely informal businesses, i.e. unregistered businesses, very small businesses. So very entrepreneurial slash small business culture that needs these payment terminals. The growth runway for StoneCo, in my opinion, is wide, and they have a long way to go. And this was for the longest time the second cheapest stock. For the longest time, StoneCo was just behind HIMS in terms of being cheap. It was trading at a 0.8, 0.7. Now StoneCo, I regret to say, has gotten a little more expensive at a 0.152. So it's gotten a bit more expensive. It is still cheap. Let's be honest. It's still the third cheapest out of all of the stocks that I cover, but not as cheap as it once was, because HIMS was once. HIMS is still the cheapest stock. Oddity is cheaper than StoneCo, very interestingly. And if you do the rule of 80, it's a rule of 80 for StoneCo. StoneCo is the winner of my rule. The rule of 40, it's double the rule of 40. It is the winner of my rule. StoneCo achieves rule of 40 on its own on EBITDA margin at a 46% EBITDA margin. If you've watched my videos on StoneCo, you know that I like to joke, and I like to say that this company is in the cash printing business, and then it is in the cash piling business. To my despair, they are sitting on a giant pile of cash, and I like to joke that they're in the cash minting and cash piling business. But understand that. Think about the size of that shovel. When you have a 46% EBITDA margin, think about the size of that shovel. Every dollar of transaction fees that you get on those terminals, every dollar of transaction fees becomes margin at a rate of 46%. So you make 46 cents out of every dollar. So it's not quite as profitable as Visa or MasterCard, but it's pretty close. It's pretty close to the profitability of a Visa or MasterCard. This is very impressive at 46%, especially for a business that's predicted to grow at 41%, so much faster than the rest of the economy. Much faster. They're predicted to grow much faster. So anyways, love StoneCo. Another new stock for this channel, which I have covered recently, and it's in a new space. It's in the medical technology / med tech space. It's called SWAV. So Shockwave. SWAV is the ticker symbol. Shockwave Medical is the name of the company. Really briefly, what they do is it's a catheter that the doctor is going to put into your veins to break calcium. Typically, it happens in the legs. You have calcium deposits. It's related to heart disease, right? And so the blood flow may be impeded by calcium in your veins. And so this is a device that the doctor will input, and the device uses sound waves to break calcium deposits inside your blood vessels. So the calcium deposits inside your blood vessels can be broken through sound waves, and this is a brand new technology. This is a breakthrough technology. Much of the old way of doing that used to be done by injecting a balloon that a doctor would pump with air, but they find that using sound waves is twice as good, and the product is literally getting adopted left and right. Revenue growth is 57%. A bunch of the key to product adoption of Shockwave Medical is getting it reimbursed by different players in different countries. But nonetheless, at revenue growth predicted to be 57% over the next 12 months, that's pretty outstanding if you ask me. The gross margin is predicted to be 87%. So this is almost pure profit, this product. And they also have a recurring revenue component in the sense that they sell disposable. So over time, they will increase that even more as they sell more and more disposable product. As far as the price of that growth, it's pretty cheap at a 0.18. So we're not paying that much for that growth. And the EBITDA margin, they're already there. They're at 26% EBITDA margin. And you're like, okay, well, with 87% gross margin, it's easier to make this much gross margin. But anyways, if you add up the predicted revenue growth, you add that up to the EBITDA margin, to the current EBITDA margin, you get a rule of 80 at 83. So this is a very compelling stock, in my opinion. Moving on to Mercado Libre. So what about Mercado Libre? Mercado Libre is a stock that is the leader in Latin America. They are number one in Brazil, number one in Mexico, number one in Argentina, doing very well in Argentina, actually managing their hyperinflation environment. It is the beloved e-commerce platform for much of Latin America, in a world where Amazon has not succeeded, in a world where Sea Limited was not very successful in Brazil, in a world where even the local incumbents like Americanas went bankrupt in Brazil. Mercado Libre is doing so well, and the enterprise value over gross profit over revenue growth. So the question here, how much am I paying for that growth? I'm at a 0.3, so I'm below that average in the spreadsheet, but I'm still pretty darn cheap as far as the cost of that growth. Rule of 50. If you add the EBITDA margin of 19% plus 35% revenue growth, you're at a rule of 50 out of 54. And one thing that I must say about Mercado Libre is that it's what I call a sleep well at night stock. It's the most uneventful, easy stock to follow. It's like there's no binary event. They got the business figured out. It's slow and steady, but not slow because it's growing at 35%, so it's not that slow. But it's as steady growth as it gets. It's like every quarter it beats, it raise, every quarter beat and raise, and the business is doing so well, and they have very little competition. So this is a steady Eddie business, which is actually still pretty cheap at these levels. Okay, the stock rebounded quite a bit, but considering that the sales have been chugging along at a growth of 35% year over year, this is a business that has not caught up with the sales growth that it has had. And I believe there's still some multiple expansion going on in this business, knowing that this business is also pushed forward by the drop of interest rates, which is improving the economy of a lot of nations in Latin America, like Brazil, who already dropped interest rates. Tons of tailwinds for Mercado Libre. Another tailwind that comes to mind is their payments division. They have Mercado Pago, which is doing really very well with micro businesses. It's an app, right? And they're slightly competing with StoneCo, although StoneCo focuses a little bit on micro businesses, but StoneCo focuses more on bigger businesses. Advertising, like most e-commerce story, Mercado Libre will be an advertising story as well as they start implementing this. So tons of optionality for this company, and I'm very happy to own it. And the last stock, and it's always the same story whenever I cover Airbnb. So the last stock is Airbnb. I seem to be the only one who seems to be loving and covering Airbnb. That's okay. I'm on my own here. Why do I love Airbnb? Airbnb is again in a different sector. What is Airbnb? It's the platforms. I love platforms personally. I think platforms are some of the most wonderful businesses because with a platform, you don't have to make the product. Right? With the platform, it's someone else who offers the product on the platform for you, right? Airbnb doesn't have to set up any rooms, doesn't have to come up with concepts for, lodging concepts or boutique hotel concepts. They don't have to come up with any of that. It's a two-sided platform where it's the seller, the owner of real estate, who will come with the concept. Right? And Airbnb also doesn't really have to spend much money in the way of customer acquisition because customers come on Airbnb because of network effects. Right? Why do you go on Airbnb? Because everybody's on Airbnb. Like every single short-term rental is on Airbnb. So if you're interested in a short-term rental, you really don't have a choice but to use Airbnb. So Airbnb is a complex company to describe in a 9-stock video, but in a nutshell, they grow with very little capital. They grow very quickly. They are a threat to hotels, as the CEO says. For each 10 hotel rooms that are booked, only one Airbnb is booked. And so it should be much, much more. And it should be much, much more. And it might be more because Airbnb is the preferred mode of travel for Gen Z and early millennials. It's their preferred mode of travel. You have people who are in the habit when they travel of just looking at the Airbnb app and not really thinking about hotels or hotel brand or even Expedia or anything like that. I believe over the long run, Airbnb is even a play of a disruption of a mom and pop rental business. And you see this with apartment buildings who are already partnering with Airbnb, trying to cater to the digital nomad and the changing nature of work. Fascinating business in my view. I'm the only one who thinks that. That's okay. Revenue growth is at 22%, and they're a little bit of a cash making business too at Airbnb at a 24% EBITDA margin. So if you add both the forward revenue growth and the EBITDA margin, you're at a 46%. So you're at a rule of 40 for Airbnb now. That is very good. That is excellent. in my view. And the growth is a little more expensive at a 0.47, so a little more expensive than this average. But if you compare this to my video where I go through all 32 stocks that I cover on the channel, you know that a 4.7 is actually second quartile, right? It's not that expensive, right? It's still in the second quartile. The only quote unquote expensive stocks that I would have on this spreadsheet in the way I value stocks would be Tesla, Enphase, and Crowdstrike. These are the only traditionally, more expensive stocks. But again, you gotta take valuation, in my view, and expensiveness, quote unquote, in my view, with a grain of salt, because some companies can stay. Not some. Many companies stay overvalued the entire life of the existence of the company, right? Look at Amazon. Amazon is still overvalued, and it's way past 100 bagger, and it's done it undervalued the whole time, the whole way up. It's been undervalued the whole way up. So the market sometimes values some companies some more, and we don't really know why. That's just the way it is. But if the stock stays quote unquote overvalued for a 20-year period, okay, well, it's going to be overvalued when you sell it, and it's overvalued when you buy it. So it doesn't really change too much, if that makes some sense. Except that, of course, it makes you feel uncomfortable sometimes, because you're like, okay, well, I'm paying up. But you're paying up for quality, you're paying up for premium. Another stock that comes to mind as often overvalued in my view is not McDonald's, it's Home Depot. Home Depot is a stock, when I look at the metrics, this is so overvalued. But it's been overvalued all the way to 100 bagger. So anyways, that's just a grain of salt about valuation. Rule of 40 is independent of valuation. So that's why it may be a very useful tool to identify a great business, because Rule of 40 does not depend on valuation. Rule of 40 only takes into account revenue growth and EBITDA margin. So there's no valuation in Rule of 40. So it's almost a more fair way to assess businesses in a way, if that makes some sense. Anyways, I hope you liked this video. This was not investment advice. This is just entertainment, no investment advice. I hope you were entertained. Please like, please subscribe, please follow me on X if you can. That really helps me out. Thank you for watching, and have a wonderful day.